Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. On today's show, I got to tell you what the Wall Street Journal says. Yeah, you know the Wall Street Journal. They're the big, ginormous entity that everybody turns to for financial advice. Yeah, I mean, they've been around forever. I remember when I was in college, it was like the thing to do, especially if you were a business major, to have a subscription to the Wall Street Journal. Well, when I was in college, I couldn't afford a subscription to the Wall Street Journal, but fortunately, I had fraternity brothers that could. And after they read the paper, they were more than happy to share the paper with other people. And I spent some of my college time reading the Wall Street Journal because I found it gave me a pretty diverse set of information that I can use and I can apply to different things that I was learning. And eventually I graduated college, and all that business stuff kind of went on the back burner because I spent the next 27 years of my life in the United States Army. Now, having said that, there is a business component to the Army. Believe it or not, there are still fundamentals in place that say you can't spend more than you're allocated. Because if you do that, bad things will happen to you. Don't be that person that does that. Don't overspend your budgets. So what's this got to do with the Wall Street Journal? Well, a lot, actually. A lot. Because even though I don't focus as much on the Wall Street Journal as I used to when I was in college, every once in a while, the Wall Street Journal will cite an article, and it catches my attention. It really does. And this article that I'm reading today, holy smokes, it reinforces everything I've been telling you guys. Everything. Let me just start off with the headline. It says, soaring rents make it a very good time to own an apartment building. You heard me correctly. Let me read that again because I think this is really good news. Soaring rents make it a very good time to own an apartment building. The byline, and the byline I think is even more important. It says, the 10% rise in national asking rents in August is the highest on record. You heard me correctly. It's the highest on record. And it's helped by young workers returning to cities. That's what the Wall Street Journal says. And I don't disagree with them, but I think there's a lot more going on there. I really do. I think part of what we're seeing right now in the housing markets is the housing markets adjusting to the federal government taking their boot off of our necks. Yeah, I said it. I said it. The federal government, as well as some state governments, as well as some municipalities, think that owning investment property is usury. Yeah, that's what they think. They think that we abuse our residents. They think that all we're interested in is making money. Okay, there's a sense of truth to that. We are interested in making money, but it's not the only thing we're interested in doing. Now, I can't speak for every real estate investor out there. I cannot. Because there are real estate investors out there that I think are terrible people. And I call those people slumlords. Yeah, I call them slumlords. Those are the people that give real estate investing a black eye, a bad name, a bad rep, the whole 9 yards. I think slumlords are terrible. And if I could eradicate all of them from the system, I would do that. But I don't have the ability, and I certainly don't have the Army to do that. And to be honest with you, I don't have the inclination to do that. I really don't, because America is free. America is free. And people have a right to choose what they want to do. If they want to choose to pursue a business endeavor, which is really a failed model, go for it. Because what I'll do is I'll wait for you to fail, and then I will buy your asset. I will repurpose that asset. I will put it back in inventory as a much nicer piece of property that's available to individuals that want to rent. And I will develop a great business relationship with them. They'll pay me on the first of the month. I will maintain that property. And for as long as we have a business relationship as codified by a lease, we're going to be good to go. That's the way it is. Now, let me go back to this 10% rise because, man, I'll tell you, a 10% increase, in your asking rents is pretty significant. That's a pretty significant jump. And I think part of the reason we're seeing this significant jump occur is because we're finally starting to see all of these governmental entities realize that we're not Satan. We're not the bad guys here. As real estate investors, especially the group that I belong to at Lifestyles Unlimited, we provide some great quality workforce housing to a segment of the economy that absolutely desires it and demands it. Yeah, we do. But when the government tells us you can't evict people, when the government tells us there's a moratorium in place, when the government tells us that they're going to control our business model, all we can do is work within the confines of that control. Well, now a lot of this control has been taken away. This control no longer exists, at least at this very moment. It doesn't exist. Now, there are still municipalities out there, you can read about them, still some states out there that think they're going to stand up and they're going to take care of the renter. They're going to make sure the renter doesn't get evicted. And they're going to put all these moratoriums in place, and they're basically going to try and pin everything on our backs. And I don't buy that. I don't buy that at all. I really don't buy that at all. It's not the way to do business. That's not a free economy. But when we come back from the break, man, a 10% bump in asking rents. What does that mean? Well, I'll tell you when we come back. Stick around.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. Hey, before I get into this 10% thing, I need to read you an email that came from my fellow Lifestyles Unlimited member, Daniel. Now, as many of you know, last week we had it wasn't last weekend. It was the weekend prior. It was over Labor Day weekend. We had our Wealth and Passive Income Expo. And Daniel's one of these guys that I've been corresponding with back and forth for quite a while. As a matter of fact, we've developed what I would consider a friendship. Although I don't think I've physically met Daniel in person. Now, Daniel may have a different opinion on that. And to be honest with you, I'm one of those guys that am terrible with names. I am awful with names. Now, I could look at you. I can identify who you are. I could probably go to that moment in time where I first met you. I could remember what was going on in the background when I first met you and all these things. But for the life of me, I'm terrible with names. And probably a career in the Army was a good thing for me because, in a military uniform, you address people by their rank and their last name, which is clearly identified on the uniform. So I had about a 27-year cheat sheet. Yeah, I had a 27-year cheat sheet. Now, Daniel, he was not at Expo. And some of you are like thinking, oh, what did Daniel do? Did he get in trouble? No. Actually, Daniel was not in trouble at all. Daniel went on a cruise. Yeah, he went on a cruise. Yeah, and he had a blast. Now, the reason I'm going to tell you some of the things that Daniel shared with me is because I know some of you want to go on a cruise. It's kind of like no man's land out there. What's going on in that environment? You know, you hear all this stuff about testing. You hear all this chatter. Okay, so Daniel sent me back an email, and it eliminates all that clutter. It eliminates all that clutter. So let me tell you the most important thing that Daniel told me. He said, if you like cruising but hate standing in line, you should cruise now. The ship he went on was half full. Now, it's possible the ship that he went on was only half full because all the Lifestyles Unlimited members were up in Dallas doing their thing. It's possible. I'm not saying that we have an impact on the cruising industry or capacity on ships, but, you know, that might have been a thing. But Daniel said this, there were no lines for anything. No lines for anything. He said, now there's big time enforcement on masks and hand sanitizing. I mean, they're doing those things to, you know, try and make everybody as safe as possible. I get that. But at the end of the day, Daniel says this, if you're thinking about going on a cruise, do it now. Do it now. You'll have an outstanding experience. As a matter of fact, don't do the little short cruises. Do the long ones. Do the 7-day cruises. Because why, as Daniel put it, why would you spend all the trouble packing and transporting all of your stuff and yourself to and from the cruise line and so on just for 3 days? And he makes a lot of sense. He makes a lot of sense. Now, he said there's still a need to prove that you have your vaccination, and they're making you get a negative COVID test like 2 days prior to sailing and all. Okay, so all that stuff is still going on. But at the end of the day, Daniel had a really good time. And here's the other thing I want you to know about Daniel. Daniel just closed on his last single-family house. Now, he didn't buy one. He sold one. As a matter of fact, what Daniel has been doing over time, even during this whole pandemic, Daniel's been transitioning his investment portfolio away from single family and into multifamily. And I think he's making a really good decision, especially when I read this Wall Street Journal article that tells me that there's a 10% rise in the national asking rents in August. A 10% rise. So what does that mean? Okay. It means that an apartment that was on the market for $1,000 in July is now on the market for $1,100 in August. And I realize we're past those months. I get that. But that's what a 10% bump looks like. Now, usually you're able to adjust rents over a period of time. And there's reasons to move rents upward that have nothing to do with increasing your bottom line. Sometimes you just make rent adjustments because there are certain things that you don't have control over that are driving your financial decisions. Things like property taxes. Property taxes are something you don't have any control over. The taxing entities where you own your property they all tell you how much you're going to pay in taxes. And they tell you what entities will receive those taxes. I don't know about you, but when I get my tax statements, it's broken down based on all of the entities that are taxing me and what their tax rates are and how much is going to each entity. That's a pretty big chunk. And the tax entity likes to increase taxes. I mean, they're on board with cost of living increases, right? They're like, well, everybody else is getting a COLA. Why don't we get a COLA? Let's get a COLA too. So taxes have a tendency to ratchet up over time. So if you don't want to have your cash flow adjusted downward, you might have to consider what the cost is for the fact that the taxing entities are going to charge you more, and you may have to work that into your rent. Now, another thing that occurs has to do with insurance. Insurance becomes more expensive over time. The insurance policies that I buy today cost more than the insurance policies I bought 5 years ago or 10 years ago. It's a function of the economy. The insurance agencies are not interested in getting behind the curve when it comes to their financials, because the insurance industry is one of those ginormous entities in our country that has an ability to move markets. It really does. It's that big. And when you consider all the natural disasters that have occurred, even though we've been in a lockdown, a lot of people have been affected by that, which affects the amount of money that the insurance providers pay out. So as a result of that, you might have noticed that whatever your costs for insurance are, those numbers might have gone up a little bit. So maybe part of your planning process, you take into account the fact that there's adjustments in insurance that just naturally occurs, and you build that into rent increases that you may be projecting for future months. Now, you can't just arbitrarily go out and change rents. No, you can't. Because when you sign a lease, you agree that you will charge a certain amount of money, and the resident will pay a certain amount of money for that time period that you lock in. But I will tell you this, I've got several leases that are getting ready to expire. And based on this Wall Street Journal article, man, I got some decisions to make. We come back, I'll tell you what I'm thinking. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. So you're probably wondering what I'm going to talk about now, because some of you are concerned that rents are going up. Some of you are elated that rents are going up. And I know who's in which camp. See, if you're somebody that rents, by the way, which is something I am currently doing right now. Oh, you didn't expect to hear that, did you? No, you did not expect to hear that. I am a resident. I am renting my housing right now because I sold my principal residence a little while back. It closed escrow. I harvested a bunch of money out of that asset. Oh, wait a minute. Technically, it's not an asset to me because I was living in it and consuming it. But once I transacted that property and made it go away, I walked away with a big pile of money that I would not have been able to tap into had I just done a refinance. Because the refinance rules basically say you need to have 20% equity. Well, I wasn't interested in leaving 20% equity in that property. And that property I actually outgrew it. Now, it was a beautiful home. It was a great neighborhood. I really loved living there. But that was the house that was designed for me to initially retire into, my fort living room, if you will, and the place where my children would finish up high school and then transition into college. Well, that's all occurred. So rather than sit in a house that, was probably a little bit bigger than what I needed and wasn't quite doing anything for me. Oh, by the way, Mrs. Gordon, she gets the itch every once in a while. And I don't mean that kind of itch. I mean, she wants a new canvas. Yeah, she wants a new canvas. She had pretty much done everything to the home that we had lived in. It was a beautiful home. My wife has the eye that interior designers would crave for. Yeah, that's the talent my wife has. And she creates beautiful living spaces for myself and my family. Well, the canvas had pretty much, we had done everything that we could do on the canvas. And that house wasn't doing anything for us financially anymore. So we made the decision to sell and transact that property. So in the meantime, I have to have a place to live, because the property I was going to buy didn't quite turn out the way it was supposed to, because I could pin blame on whoever I want. It doesn't matter. The bottom line was the appraisal on that property came in $110,000 below what we were offering for the property. And I believe that somebody misrepresented valuation along the way. Different story. Doesn't matter. Not funding on that house because we walked away from it. Instead, I found a different house that's, believe it or not, it's actually a little bit bigger. It's actually a little bit bigger than what I sold. But the layout is so much better. It's so much more youthful for my wife and I. And it's on a bigger piece of land. It's got a creek in the backyard. It's got all these little buzz factors that we love. And it's, believe it or not, it's 10 minutes away from where we used to live in the same city. Yeah, so things changed for us. And we're looking forward to moving into that property at the end of the month. But in the meantime, I'm a resident. I am renting a home. It's about 1,500 square feet, 3-bedroom, 2-bath, 2-car garage. It's the sweet spot for what we like to invest in at Lifestyles Unlimited. It's cozy. Okay, cozy is code for it's small. Yeah, it's small. It's smaller than what I'm used to, but I will tell you this. It's big enough for my wife and I right now. And, of course, we got the dogs here, too, so everything's going good. So I actually have a unique perspective on what it's like to be somebody who rents in the current marketplace. And that's not where I want to go in this segment. Maybe I'll talk about that tomorrow. But I want to talk about what this 10% rise in asking rents means. It means that finally, the apartment industry, as well as real estate investors that invest in single-family properties, are starting to see that the government is taking some of the pressures off. We're starting to return to a more market-focused economy when it comes to housing. For whatever reason, the government thinks that it has to save everybody from doom and gloom. And sometimes in that broad stroke that they use across America, because remember, the government has to do one size fits all, and we all know that one size doesn't fit everybody. We're all different. We get that, right? I mean, we talk about diversity, right? So we all agree we're all different. But having said that, the government thinks that one size fits all, and that whatever they lay down as policy is good for everybody. That's not true. So now that the eviction moratorium is gone, now that we can finally start helping people understand that it's not my responsibility to provide you a place to live. It is actually your responsibility to do that. It really is. And I'm willing to enter into an agreement with you to provide that housing, but I expect that agreement to go both ways. I absolutely do. That means if you live in my property, I expect you to pay for that property. I also expect that if you're going to be financially damaged by whatever occurs in the world, that you are man or woman enough to have a conversation with me to say, hey, you know what? My life just went sideways, and let's see if we can put together a plan of action to get you through it. Because that's how I deal with my residents. Yeah, that's how I deal with them. But here's the interesting thing. When rents go up 10%, literally overnight, it means that the market is adjusting to what the market will bear. It means there was, in Al's opinion, and I'm sure there's a lot of economists out there that would probably support this opinion I'm about ready to make, there was downward pressure on pricing. Because here's the thing. I didn't raise any rent. I didn't raise any rent during the pandemic. None. I wasn't going to go there. Now, the taxing entities, did they raise my taxes? You bet they did. The insurance companies, did they raise my insurance? Even though I had no new perils, you bet they did. So who loses? Who loses when the government decides to impose artificial pressures onto the economy? Well, the investors. And there is some stinking thinking going on in this country that says, oh, you know, you're an investor. It's okay. You'll be okay. You have lots of money. You're an investor. Yeah, it's not true. It's not true. As a matter of fact, talk to a guy by the name of Gordon. Now, Gordon's been on the show before. As a matter of fact, Gordon is one of these guys that he knows what it takes for him to sustain himself. And Gordon also became a member of Lifestyles Unlimited to get out of the doom and gloom of working in a job that wasn't getting him to where he was trying to get to. And Gordon figured out when he became a member that his magic number was 6. It was going to take 6 single-family homes for him to step away from a 9-to-5, day in and day out job. And he got to 6, and he retired himself. Gordon retired himself on 6 properties. But Gordon is also one of those guys that didn't raise rents. He didn't raise rents during the pandemic, but Gordon's taxes rose and Gordon's insurance rose. So Gordon, his cash flow was affected slightly, not terribly, but slightly, and he got through it. But I don't think that's fair to make guys like Gordon pay for everybody else. When we come back from the break, I'm going to give you what I promised I was going to give you this segment. Stick around.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. All right, last week I promised you I was going to do a better job of getting my contact information out to you, and so far I've pretty much failed you guys this week. Yeah, we've gotten to today, and I haven't even put out my email address, which is the best way to get a hold of me. Now, I may not respond instantaneously because I do get more than one email a day, but I do promise you this. If you email me at askal@luinc.com, again, that email address is askal@luinc.com. I will respond to you. It may not be instantaneously. It may not be in the next 24 hours. Heck, it may be a couple days from the day that you send it in. But just know this. I will get to it. I will get to it. And if you have a real estate related question that you would like to ask me, send me that email at askal@luinc.com. Or you can be like Daniel and just tell me how your cruise went, because I want to know that kind of stuff too. All right, no, okay, let me back away from that. Okay, let me back away from that. I want qualified information that is non-real estate related. So, okay, just don't spam me. I'm not interested in being spammed. Okay. What I need to explain to you right now is how a 10% increase in rents will affect your margins. I mean, I just used all the big, business school buzzwords on you, and I apologize for that. Let me go to the words that Al really understands. Okay, if we are able to push our rents up 10%, what that means for us, provided that we're controlling all of our other costs, we're going to be the beneficiary of increased cash-on-cash returns. In the single-family space, that is going to be the benefit to us as real estate investors. But if we are doing this in the multifamily space, there's actually 2 things that occur. And this is why multifamily apartment investing is your next step from single-family. Not only will you be the beneficiary of cash flows going up, you will also be the beneficiary of the value of your property going up. Now, some of you are sitting back and going, oh, wait a minute, man, that doesn't make sense. I mean, if I got a single family house, that property value is going up, right? I agree. It is going up, especially in the current marketplace. It's definitely going up. I mean, I just looked at what some of my properties are potentially valued at, and I'm like, wow, I've hit my 3-year targets in less than a year on these properties. That's what's going on in the single family space. But if we jump into the multifamily space, valuation is looked at completely differently. Instead of saying, what did that house over there sell for? And what did that house over there sell for? And what did that one sell for? And are they comparative to this particular property? And does the pricing that was agreed to on those properties merit the pricing that was agreed to on the subject property? Yeah, I just explained to you how single-family duplexes, triplexes, and fourplexes are valued based on a market analysis. Yeah, called an appraisal. Multifamily, different animal. It's all based on the financials. That's it. It's all based on the financials. So if you can do that, now check this out. I'm about ready to blow your mind. I'm about ready to blow your mind, and I'm going to try and do this with as little math as possible. A 10% increase in your net operating income in apartments. Okay, and I just lost some of you guys, so let me take a step back. Apartments are valued based on a simple formula. You take all of the income that apartment produces, you subtract all the expenses except for the mortgage payment, and you come up with something called net operating income. You use that net operating income based on, a trailing calendar, depending on who's doing the financial analysis. Some like to use the last 12 months worth of financials. Some use 6, some use 3. It just depends on what's going on in the marketplace. But when your net operating income is divided by the prevailing cap rate for the asset class that you're investing in the location you're investing in, it creates value for you. It does. It creates value. So when I read this article that says asking rents went up 10%, that's huge. That's huge because we don't normally push apartment rents up 10%. No, that's a pretty high push. That is, across the board, that's a big push. And that just tells me that rents have been suppressed for so long. That's just what the marketplace is saying we're willing to pay. Because if people weren't willing to pay that, we wouldn't be able to obtain it. I mean, we could offer it, but people wouldn't be signing leases. You cost too much. I'll go over here. This guy's $50 less. Nicer property. Yeah. I mean, that's how people do stuff still, usually. But a 10% increase in that NOI allows you to do two things. Number one, depending on how you're structured with your financials going into the deal, in many cases, if you can obtain a 10% increase in your NOI, what that tends to indicate is that the amount of capital that you actually put into the deal, you may be in a position to actually take it back out of the deal and still have equity in the deal. So what does that mean? That means if you own an apartment building, you may be in a position where all the money you invested into that property is now available for you to take out of that property. You heard me correctly. So you put yourself in a place where you have $0 of your own money invested into that asset. Yet that asset is still going to produce 5 different ways for you, technically 6 different ways because we're talking about multifamily. Here's the other neat thing that happens. Apartment buildings will provide you a cash flow stream. They will. When you correctly invest, those assets will produce cash flow streams for you because at the end of the day, if the asset doesn't produce cash flow, you shouldn't be investing in it. I know there are people out there telling you, oh, don't worry about the cash flow. It's all about appreciation. Yeah, that's stupid. It is all about the cash flow because you can't retire yourself on appreciation. Okay, you kind of can, but the mechanics are wonky. They're really wonky. Retiring yourself really comes from having that cash flow come in. So when you have an asset that's producing a cash flow rate, let's just pick a number out of the air. Let's just say you own an apartment that produces cash flow of $30,000 per year. That's what goes into your pocket every year. And if you can increase the overall value of that property by 10%, Based on the fundamental math and the way we invest into properties, that means you are doubling your cash flow. You're going from $30,000 to $60,000 in cash flow. Now that is significant. And that is exactly what that article triggered in my mind, is that we're going to have a lot of apartment buildings that are all of a sudden going to start pushing out more cash flow because they're being operated more effectively and the market is willing to pay more for the rents. And here's the other thing. If you decide to take money out of that apartment, if you decide to do a cash out refinance because it makes total sense to do it and take all of your money back out, that will have a negative effect. It will have a negative effect, slightly negative effect on your cash flow, because you're going to put a higher debt amount on that property. So your debt service is going to command a little bit more of what you pay out after the net operating income. So your cash flow might go from, say, $60,000 down to $40,000. And some of you think, well, that doesn't make sense, because if I'm living off $60,000, how can I live off of $40,000? Real simple. That money that you put into the deal, that now you're able to pull back out of the deal, you go out and you buy yourself another asset that produces, say, $30,000 of cash flow. Problem solved, right? As a matter of fact, you just made yourself an extra $10,000. Oh, and if you position this asset correctly, you're going to be able to do the same thing that you did with the first one. Oh, so now you're going to have $80,000 worth of cash flow with none of your money actually in a deal. But now you're going to have all that money back. So what are you going to do? Is it time for jet skis now? No. Go buy more real estate. That is the important thing. Put assets in your basket. 10% rise. I'll tell you, it's a game changer. And if you want to find out how you too can get into the game changer mode, go to lifestylesunlimitedworkshop.com. Get signed up for one of our free workshops. Let's get you going.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.